Did you know that over 80% of retail investors lose money in the stock market? That's right. Most people who invest, especially those who follow popular trends, end up regretting it. The real kicker? They don't even realize they're making huge mistakes until it's too late. Now, imagine if you could avoid these mistakes. What if you could learn how to invest smarter, protect your money, and actually grow your wealth? Well, you're in the right place. In this video, we're going to uncover the 6 investing mistakes that could haunt you forever. These aren't just common errors, these are the big ones that experienced investors regret for years. I'll also show you how to spot them before they happen, so you can make your money work for you, not the other way around. Stick around, and by the end, you'll know how to avoid these traps and make smarter, safer investments. You don't want to miss this. Chapter 1. Chasing the next big thing. The temptation of hot stocks. We've all been there, watching the news and hearing about that hot stock everyone's talking about. It feels like everyone's making money, and you don't want to miss out. But the truth is, most of these hot stocks are overpriced, and chasing them can lead to big regrets. Warren Buffett once said, "Price is what you pay, value is what you get." If you're jumping in because of the hype, you're probably paying a price that doesn't reflect the true value. In value investing, the key is to focus on long-term potential, not short-term excitement. A good example is when tech stocks like Amazon or Apple were overlooked because they didn't have immediate growth potential. But those who held on to them saw huge returns because they were able to see past the hype. Here's a stat: 90% of day traders lose money. Chasing trends rarely works, especially if you're new to investing. Instead, focus on companies with solid fundamentals and stay away from speculative, get-rich-quick stocks. The strategy here is simple: look for value. Analyze companies based on earnings, assets, and their long-term stability. Don't get caught up in the rush of hot stocks. Value investing is about patience, not quick gains. Chapter 2. The growth at all costs fallacy. Sacrificing quality for speed. Many investors get blinded by high growth rates. They look for companies that are growing rapidly, even if they're losing money. The idea is that fast growth will eventually lead to profits. But as legendary investor Charlie Munger often says, "All I want to know is where I'm going to die, so I'll never go there." Growth at all costs can be dangerous. It's easy to get excited about companies reporting big numbers but with no real profit. For example, in the late 90s, we saw the dot-com bubble. Everyone was rushing into tech stocks, ignoring their lack of real profitability. The result? A market crash that wiped out billions. A key strategy in value investing is finding companies with solid fundamentals that are growing in a sustainable way. High growth is great, but not at the cost of losing the essence of the business. Look at profitability, cash flow, and balance sheets. That's the real indicator of success. The truth is, not every company is meant to grow at a crazy rate. Quality businesses with slow but steady growth tend to offer better long-term returns. Think about Warren Buffett's investment in Coca-Cola. It wasn't the fastest growing company, but it had strong fundamentals and great long-term prospects. Chapter 3. The dreaded buy and forget syndrome. Neglecting your portfolio. Just because you've invested in a company doesn't mean you can forget about it. Many investors make the mistake of buying stocks and then letting them sit without reviewing. As Buffett says, the stock market is a device for transferring money from the impatient to the patient. Value investing is all about paying attention. It's not enough to buy undervalued stocks and hope for the best. You have to continuously monitor your investments to ensure they're still on track. Businesses evolve, markets shift, and the global economy changes. If you're not paying attention, you could miss out on important signals. Take Sears, for example. Once a giant in retail, but by the time many investors noticed it was in trouble, it was too late. Regular portfolio checks would have alerted investors to the decline, allowing them to sell early and protect their capital. A smart strategy is to schedule regular reviews. Keep track of how your companies are performing compared to your expectations. If things change, either for the better or worse, you'll want to adjust your investments accordingly. Regular monitoring doesn't mean checking every day, but staying aware over time. If you found this tip helpful, don't forget to subscribe and turn on the notifications so you don't miss out on more investment tips. Chapter 4. Overpaying for value. When a deal isn't really a deal. Here's a big mistake. Thinking a stock is a good deal just because it's cheap. But as Buffett warns, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The key to value investing is buying companies that are undervalued, not just cheap. Many investors fall into the trap of buying stocks that are down in price but haven't really bottomed out in terms of value. Sometimes, the price drop is due to real problems that will take years to fix, or maybe the company's fundamentals are weak. The price may be cheap, but it's not necessarily a good deal. When looking for a good deal, think about a stock's intrinsic value. Calculate the business's true worth based on future earnings, assets, and growth prospects. Don't let a low price trick you into thinking it's undervalued. A smart strategy involves understanding why a stock is priced low. Is it a temporary dip, or is the company in serious trouble? Always make sure the underlying business is solid before investing. Chapter 5. Ignoring margin of safety. Taking on unnecessary risk. One of the most important principles of value investing is having a margin of safety. Benjamin Graham, known as the father of value investing, explained that investors should only buy stocks when they're priced below their intrinsic value. This gives you a cushion in case things don't go as planned. If you invest without a margin of safety, you're taking on unnecessary risk. Think of it like buying a car without insurance. You might save money up front, but if anything goes wrong, it could be a huge loss. A margin of safety doesn't just protect you from market downturns, it also protects you from bad decisions. Let's say you're buying a stock, but there's uncertainty about the company's future. If the stock is priced low enough, even if things go south, you won't lose as much. Many seasoned investors recommend a 30% margin of safety, meaning you should only buy stocks that are priced at least 30% lower than their estimated value. This strategy reduces risk and helps you avoid costly mistakes. Chapter 6. The dreaded recency bias. Getting stuck in past performance. It's easy to make decisions based on recent trends. If a stock has been performing well, it's tempting to assume that it will continue to do so. But this can be a huge mistake. As Buffett says, what the wise do in the beginning, fools do in the end. Recency bias is the tendency to rely too heavily on recent events. For example, many investors bought tech stocks in 2021, riding on the wave of strong performance. But when the market corrected, many of those investors were left holding stocks that had inflated prices. In value investing, it's essential to look beyond recent performance. Past success doesn't guarantee future results. Instead of chasing past performance, focus on a company's long-term fundamentals. Look at things like profitability, growth, and market share, not just the stock price over the last few months. A key strategy is to stay grounded. Don't let recent trends drive your decisions. Look for businesses that have consistent growth over many years, not just the past few months. This helps you avoid overreacting to short-term movements and makes for smarter long-term investments. If you enjoyed these tips and want more, make sure to subscribe to the channel. We'll be back with even more valuable investing insights.